see so many faces, and I'd like to welcome you here. So, two things happened over the last 2 weeks, over the last week actually, that gave us a ray of sunshine. That was the first. So, it was wonderful to be part of this. It was wonderful to see that we actually can put a whole lot of people together, good management, all the country's resources to achieve what we achieved. I thought that was absolutely amazing. But another thing happened, and others would see this as a negative. But if you think about it, Moody's didn't downgrade us, which was absolutely amazing, because if you think about it, both S&P and Fitch, S&P is the blue line, they downgraded us 2 years ago, both Fitch and S&P. And that's the reality of things. We don't deserve to have an investment grade. If you consider all the things that are going on, we actually deserve to be where the others are. And this is borne out with this slide, where it actually costs investors more to insure our bonds if they buy our bonds than both Russia and Brazil, who are both below investment grade a long time ago. So let's have a look at the factors that are negative and why this is the case. So if we look at the US dollar, it's going down. Interest rates in the US are going down. They've gone down 0.75% over this year. And why is that such a good thing? Well, it's a good thing because investors that would have invested in the US market at less than 1% are now looking for better returns. So they take those funds and they come and invest them in emerging markets like South Africa, and they buy our bonds, which is a big flow of capital to this country. So the negative of this, of course, is that we have to keep interest rates high so that we keep attracting them here. Just as an aside, the US dollar accounts for 62% of the world's currency reserves. The euro is only at 20%, and the Chinese currency is less than 2%. It just shows how strong and how prevalent the dollar is in the world's economy. It also accounts for over 90% of all forex trade. The EU is an unholy mess. Okay, it's 12, 13, 14 governments all trying to make sense of what is happening. It's a problem. It also has negative interest rates, which is the first time this has ever happened. So we always assumed that interest could get to zero. For the first time now, we're seeing interest rates go below zero. So what used to be an absolute zero is now relative to infinity. So they could drop interest rates to anything. But think about it this way. So if you took €1,000, you invested it in a European bank, and you kept it there for a year, after a year, you would get back €990. How amazing is that? Not only that, but the inflation rate in Europe is actually very low. So what happens is you don't buy today, you buy in a year's time because it's cheaper in a year. So there's no consumption, there's no investment, and this has led to a major problem in Europe. How is that an issue for us? Well, their focus is on what's happening there. Their demand for goods and services coming out of this country is less, and of course that affects us. Less exports means less business activity in South Africa. This is probably the biggest issue, and there seems to be some light in the tunnel. Between the US and China, we trade to the value of 400 billion rand. I mean, that's a massive amount of trade that goes on between the countries. China's growth rate has dropped to the lowest in 15 years because of what's happened between the US and themselves. So think about it this way: 400 odd billion dollars is traded one way from so America buys 440 billion dollars from the Chinese, and the Chinese buy 120 billion from the Americans. So there's a vast difference between who buys what. This has led to an imbalance in their trade relations, and also there's been IT theft, as the Americans consider that, that has caused a lot of the problems that have come about. So what does that mean? It means that if the growth rate in China goes down particularly, the demand for our goods and services also go down. Brexit, nobody knows. Are we in? Are we out? Are we in? Are we out? It just keeps going. And similarly, we have the same problem here. So the focus of the Brits is really all about Brexit. If you watch the news, the British news in particular, it just focuses on Brexit. So if they're so focused on Brexit, then that's the all-consuming focus, the all-consuming business, which leaves us with less room. We have to renegotiate contracts. We may fall out of the agreements that we currently have in place with the EU through the EU. So that leaves us with problems going forward. So let's look at the local factors, and of course I think we are all ESCOM'd out. But let's look at the problem. In 1994, we produced the same electricity as we produce today with 50% less staff. At an average salary today of 600,000 Rand per annum, 50,000 Rand a month is the average salary of an ESCOM employee. They need to get rid of 16,000 staff. Can you imagine that? Can you see that? Is it plausible? Highly unlikely. But it leads to a loss of 21 billion Rand every year, on top of a debt of 440 billion. So it's an unsustainable situation. There is no plan on the table to really rectify the situation. And if this continues to carry on the way it is, it's a train smash waiting to happen. We've discussed a little about credit ratings, and there's no sign of improvement. And in February, the budget will come through. I can't see how this is going to improve, and by then we will go into negative territory by Moody's as well. That's a massive problem. Average salaries have increased in the civil service by over inflation year on year on year. The issue, of course, is that if we are downgraded, we fall out of the World Bond Index. We have a 7% allocation, so everybody that invests in bonds worldwide sends 7% of the allocation to South Africa. That means that we get a constant flow of money coming into this country because of our allocation. If we fall out of investment grade, we then fall out of the World Bond Index, which means we lose that capital flow, and the money that was in the country because of that will exit as well. The only escape valve is the currency, so the rand will absolutely depreciate. Interest on our bonds will shoot up to try and attract more capital, so we're going to see higher rates, lower value on the South African rand, and that's going to lead to a lot of problems. But think of it this way. Let's leave that for another one. Think of the rand's decline from 2011 to now. We've lost 66% of its value in 8 years. So don't look at that figure, that's actually over 8%. So we've lost 8% per year on the currency because of what's happened through Moody's and through the ratings agency, and because of what's happening in the country economically. We really need to have a change of mind, of focus, to get things going again internally. Policy implementation and stability. The medium-term budget last week, Wednesday, gave us no path forward. It didn't tell us anything. There was no, I had high expectation that we would actually have a finance minister that would stand up and say, this is what we're going to do. It didn't happen. He's left it now for February, which means in February he's got to take some serious measures to make sure that the economy moves ahead. If we consider what's happening with debt, South Africa owes 3 trillion rand. Now, that is roughly 50% of our GDP. Our gross domestic product is all the activity that happens in the country in one particular year. If we take that activity, it comes to about 5.5 trillion rand a year. If we take our debt levels, it's always expressed as a percentage of business. So we now have a debt level of 50% of our GDP. It's going to go to 60 next year, and it's going to go to 70 1 year later. That means we go from 3 trillion to 3.3 trillion to 3.6 trillion rand in a very short period of time. So what does that actually mean? It means that we have to pay a bigger percentage of our national budget every year to interest, because it's going to push up interest rates, and we're going to start paying more and more and more on interest. Just as an aside, in the UK, even though we spoke about Brexit and the reaction to Brexit, they have a growth rate of over 3% per year. Ours is a 0.5%. 3% per year, and they owe 80% of their GDP. But they pay 1% interest on their debt. We pay 9% interest on our debt. You can see how that just doesn't work out. So the budget deficit needs to be funded out of debt. So think about your budget at home. You earn a certain amount of income, you have certain expenses, but if your expenses exceed your income, you have to finance that through debt, an overdraft or however else. The government has to do exactly the same thing. How does it do it? It increases its bond issuance, and the bonds that it issues covers that debt gap, or that deficit in its budget. Now that's what causes the debt pile to accumulate to the point where we're now sitting on 3 to 3.5 trillion rand. Right, now for some good news. That was all the bad news, and there's enough of that around. So let's just have a look at the good news. So these are the portfolio returns. We started working on your pension fund in 2005. So we've gone back just 10 years to give you returns over the last 10 years. So obviously a little further back, the economic climate was more positive, so we achieved returns of 17, 15, 17, 22% in 1 year. And you can see as we've come down, 2017 was a particularly good year. Last year was a disaster. But this year, with 3 months to go, we're sitting at 7.69%. So there's a very good chance that we'll hit double digits. If we hit a 10% return, with inflation sitting at 5.37, I think we've done exceptionally well. So the real return over the last 10 years is inflation plus 5.71% every year over the last 10 years. We've had one negative year, and that was last year. Our returns have actually been in excess of our target, which is inflation plus 5%. So it's been a pretty good trip up to now. What happens from now on out depends on the economy. It depends on what happens. It affects every one of you. So the political decisions that are taken that affect the economy affect you in your pocket through this. So it's very important that you have your say and you voice your opinion. But just going back, Alan Gray, Coronation and Investec are the 3 fund managers that we put together to give us the best possible returns. And you will see that when one falters, the others come to its aid. So you always need one to pull the other 2 up. And that's why we get a very good average return above inflation and 5% above inflation every year over the last, on average over the last 10 years.